A surprising conversation recently caught the attention of the crypto community, and it started with a bold statement from actor Terrence Howard. Known for his roles in major films, including Iron Man, Howard shared a striking opinion about cryptocurrency, claiming that the future of Bitcoin could ultimately lead to a value of zero. The comment quickly spread across online discussions, not because celebrities have never spoken about crypto before, but because of how definitive his statement sounded. According to Howard, his skepticism comes from concerns about the broader financial system and the idea that digital currencies still rely heavily on traditional fiat structures. In the conversation, he explained that someone had recently contacted him with what sounded like an investment opportunity involving millions of dollars, promising relatively small returns while interacting with crypto markets. That interaction, he said, only reinforced his hesitation toward the entire space. In his view, currencies that can potentially be influenced or disrupted by digital systems carry a level of risk he simply does not want to participate in. While those comments may resonate with some skeptics, they immediately sparked debate across the crypto world, especially among investors who see digital assets as a response to the very economic instability Howard referenced. Many analysts pointed out that opinions formed through second-hand conversations often miss the broader economic framework behind decentralized currencies. For years, supporters of Bitcoin have argued that its appeal actually grows during periods of financial uncertainty. Rising inflation, expanding government debt, and continuous monetary printing by central banks have all pushed investors to look for alternative stores of value. In that environment, Bitcoin has often been compared to digital gold, a decentralized system designed to operate independently of government monetary policy. The only scenario many analysts consider truly damaging for Bitcoin would involve something highly unlikely, such as the sudden exposure of its mysterious creator Satoshi Nakamoto in a way that destabilizes trust in the network. Even then, the decentralized structure of the blockchain itself would still remain operational. Because of that, most market observers believe the probability of Bitcoin collapsing entirely is extremely small, particularly as adoption continues to expand among institutions, payment platforms, and even governments exploring digital asset infrastructure. But while that debate continues, a very different narrative is developing around another major cryptocurrency. The conversation shifts toward the leadership of Brad Garlinghouse, who recently delivered a message that highlights a completely different vision for the future of digital assets. As the chief executive of Ripple, Garlinghouse emphasized that the company remains deeply committed to expanding the role of XRP within the global financial system. According to him, the long-term mission is not simply about price speculation, but about building the most trusted, widely used, and liquid digital asset in the world. That means focusing on real-world utility, faster transactions, and a financial network capable of supporting international payments more efficiently than traditional banking systems. Garlinghouse has repeatedly highlighted how Ripple's infrastructure aims to simplify cross-border transfers that currently move slowly through legacy banking channels. By positioning XRP as a bridge asset that can move value instantly between different currencies, Ripple believes it can solve one of the largest inefficiencies in global finance. While celebrity opinions may create headlines, the companies building real infrastructure continue pushing forward quietly, focusing on adoption, liquidity, and real-world financial integration. Every time those kinds of words come out of the mouth of Brad Garlinghouse, it changes the way people look at the long-term direction of this industry. When the person running Ripple speaks with that kind of certainty about the future of XRP, it signals that something much bigger is happening behind the scenes. Recently, Ripple pushed that message even further with a major update that outlined the scale of its growing infrastructure. According to the company, more than $100 billion in transactions have already been processed through their systems across more than 60 global markets, all connected through over 50 real-time payment rails. On top of that, the stablecoin RLUSD reached a market capitalization near $1 billion in less than a year, which is a pace that immediately caught the attention of financial institutions. What Ripple presented wasn't just another announcement about blockchain technology. It was essentially a blueprint showing how the next generation of global payments could operate from beginning to end. In the traditional financial system, businesses that want to move money internationally often face a complicated web of banking intermediaries, licensing requirements, settlement delays, and fragmented infrastructure. Ripple's new framework attempts to remove that friction by combining stablecoin rails, digital wallets, liquidity hubs, virtual accounts, orchestration layers, and custody solutions into one integrated environment. The company even highlighted how payment providers can plug directly into this ecosystem without building their own fragmented network of financial partners in every country. That approach hints at a deeper shift underway in the financial system. The older banking architecture that handled cross-border transfers for decades is gradually being replaced by blockchain-based settlement systems that move value instantly instead of waiting days for transactions to clear. Stablecoins have already started capturing a major share of global transaction volume because they allow value to move across networks while remaining pegged to fiat currencies. Artificial intelligence systems are expected to accelerate this process further by automating transactions between digital services, payment platforms, and financial institutions. When you step back and look at the entire structure Ripple revealed, it becomes clear that the company isn't just building a cryptocurrency platform, it is constructing a financial operating system designed to power the next generation of digital commerce. That leads to an interesting question about the future direction of Ripple itself. Companies that position themselves at the center of emerging infrastructure often expand through acquisitions or strategic partnerships to strengthen their position. If Ripple continues scaling its payment rails, stablecoin ecosystem, and blockchain settlement network, there is a strong possibility that the company could begin targeting other fintech firms that complement its vision. Whether that means acquiring payment processors, custody providers, or tokenization platforms remains to be seen, but the trajectory suggests Ripple is thinking far beyond a single product or single blockchain. While the infrastructure narrative continues building, the market side of things tells a slightly different story for now. Trading activity surrounding XRP has recently slowed compared with the surges seen during earlier periods of excitement in the digital asset market. Exchange data showed that XRP-related exchange-traded fund volume came in around $9.6 million for the session, which is relatively thin compared to the higher numbers investors became accustomed to earlier in the year. Among the major players tracking this activity, Bitwise Asset Management led the volume rankings, followed by Canary Capital and Franklin Templeton, while Grayscale Investments and 21 Shares rounded out the remaining positions. The more interesting signal, however, is what happened in the derivatives market. Open interest connected to XRP futures has dropped to its lowest level since late 2024, suggesting that leveraged traders have largely stepped away from aggressive long and short positions. When open interest falls this low, it often means the market has entered a period of reduced speculation where traders are waiting for a decisive move before committing capital again. In simpler terms, fewer leveraged bets mean less forced buying or selling pressure in the immediate future. Historically, markets that experience this kind of deleveraging phase sometimes follow it with a sharp directional breakout, although the direction of that move is never guaranteed. For XRP holders, the most important price levels remain clearly defined. Analysts are closely watching the region around $1.27 as a critical support line. If the price holds above that area, the market may gradually build momentum toward resistance zones near $1.75 or even $1.80. If that support level breaks, however, traders believe the door opens for a potential drop closer to $1. That possibility creates a divide among investors. Some newer participants actually welcome lower prices because it allows them to accumulate more coins before the next major cycle begins. Long-time holders who have already endured years of volatility, on the other hand, are eager to see the asset move decisively higher after such a long consolidation period. Both perspectives exist simultaneously in every market, but what matters most right now is that speculation has cooled dramatically. When the leverage disappears from a market, it tends to reset expectations and build the foundation for the next phase of price discovery once new catalysts arrive. One of those potential catalysts is coming from the growing wave of tokenized real-world assets moving onto blockchain networks. A notable development emerged from the Brazilian digital asset ecosystem, when Mercado Bitcoin revealed that it has already tokenized more than $73 million worth of regulated assets across nearly 200 financial products on the XRP ledger. The company also confirmed that it intends to expand this initiative dramatically, targeting over $200 million in tokenized instruments during the next stage of its roadmap. These assets include private credit structures, fixed income securities, and equity-linked instruments that can now trade with near-instant settlement through blockchain infrastructure rather than traditional clearing systems. Ripple plays a central role in enabling this integration by providing the enterprise tools and payment infrastructure that allow Mercado Bitcoin to connect its financial products directly to the XRP ledger. In practical terms, that means regulated financial instruments issued in Brazil can be digitized and transferred with the same speed and efficiency as cryptocurrencies. The impact of this type of development often goes beyond the immediate transaction volume. When one major financial platform successfully launches tokenized products, it tends to trigger a chain reaction across the industry. Competing banks, exchanges, and asset managers start asking whether they should be implementing similar systems to stay competitive. That process gradually pulls more institutions into the blockchain ecosystem, increasing the number of real-world transactions flowing through networks like the XRP ledger. Although this activity may not cause an immediate spike in market price, it strengthens the underlying infrastructure that supports long-term adoption. Every new tokenized asset requires liquidity, custody, compliance mechanisms, and settlement infrastructure, all of which deepen the commercial relationships between Ripple and financial institutions. As these systems mature, the total value of assets moving through blockchain rails could expand into the trillions of dollars, turning networks like the XRP ledger into foundational layers of the financial system. Another interesting conversation unfolded across the crypto community on social media, where analysts debated the distinct roles played by stablecoins and native digital assets within blockchain ecosystems. One perspective emphasized that stablecoins function primarily as transactional tools because their value remains pegged to traditional currencies, making them ideal for collateralization, payments, and liquidity management. Assets like XRP, on the other hand, behave differently because their prices fluctuate according to supply and demand within the market. That volatility makes them less suitable for storing value in the short term, but highly effective for bridging liquidity between different currencies and financial systems. When activity increases on the XRP ledger, more XRP becomes locked into reserves, transaction fees, and automated market-making pools, gradually increasing demand for the asset itself. At the same time, developments outside the Ripple ecosystem are beginning to reshape how financial markets interact with blockchain technology. The global exchange operator Nasdaq recently revealed a partnership with the crypto platform Kraken aimed at enabling tokenized equities to move seamlessly between regulated financial markets and blockchain networks. The goal of the initiative is to preserve issuer rights and regulatory compliance while allowing stocks to circulate on-chain in a digital form. If successful, this model could open the door for publicly traded companies to reach global investors through blockchain infrastructure without abandoning the protections of traditional securities markets. Kraken's recent progress with regulatory approvals in the United States further strengthens the credibility of this effort, suggesting that major financial players are preparing for a future where digital and traditional markets coexist on interconnected platforms. For companies like Ripple, this evolution is particularly significant because it validates the broader concept of tokenized assets moving through decentralized settlement systems. As more institutions experiment with tokenization frameworks, the demand for efficient blockchain infrastructure capable of handling high-volume financial transactions continues to increase. The conversation becomes even more intriguing when you begin examining the individuals who quietly operate behind the scenes in the global financial system. Many of the most influential shifts in finance are not announced through dramatic headlines, but through the career paths and relationships of the people shaping these institutions. One name that has recently resurfaced in discussions around digital assets is Robert Mitchnick, who currently serves as a key leader overseeing digital asset initiatives at BlackRock. Today, he plays a significant role inside one of the largest asset managers in the world, helping guide how traditional finance interacts with emerging blockchain technology. But years before holding that position, Michnik briefly crossed paths with the crypto industry in a way that many people are only now rediscovering. During his final year at Stanford University, he reportedly spent time working as a summer intern at Ripple. At that time, Ripple was still a relatively young company, attempting to introduce a radically different idea to the financial world, that global payments could be settled instantly using blockchain infrastructure rather than relying on decades-old banking rails. While Michnik's internship lasted only a short period, it gave him an early look at the company's long-term strategy for building a digital payment network centered around the use of XRP. Interestingly, that brief chapter of his professional history rarely appears in his modern career summaries, yet it serves as a reminder that many leaders now shaping the future of finance were exposed to blockchain technology long before it entered mainstream financial conversations. What makes that connection particularly interesting is an analysis attributed to Michnik years ago, discussing how the value of XRP could theoretically evolve as adoption grows. The idea he described was relatively simple but extremely important from a financial perspective. If banks and payment institutions begin using XRP as a bridge asset to facilitate cross-border transactions, the asset would effectively function as a liquidity layer connecting different fiat currencies. In that role, XRP would need to carry enough value to process the total amount of money moving through the network. As the transaction volume increases, the demand for liquidity would naturally increase as well. In practical terms, that means the asset's market value would need to expand to support the larger settlement flows occurring across the system. The concept mirrors how reserve assets function in traditional financial markets, where highly liquid instruments absorb enormous volumes of capital moving between institutions. When applied to blockchain settlement networks, the same principle suggests that digital bridge assets could scale in value alongside the economic activity they facilitate. This theoretical framework becomes increasingly relevant as governments around the world begin moving toward clearer regulatory guidelines for digital assets. For years, many large financial institutions remained cautious about integrating blockchain technology because the legal environment surrounding cryptocurrencies was uncertain. Banks operate within extremely strict compliance frameworks, and committing billions of dollars to new infrastructure requires regulatory clarity. Without clear rules, financial institutions risk exposing themselves to legal challenges or shifting policies that could disrupt their operations. That is why the regulatory conversation taking place today is so important. Ripple executives have repeatedly emphasized that once governments establish transparent guidelines for digital asset usage, institutional adoption could accelerate dramatically. In markets like the United States, where financial regulation strongly influences global banking standards, the establishment of clear digital asset policies could open the door for banks to experiment with blockchain settlement rails in ways that were previously impossible. Over the past year, conversations between cryptocurrency companies, regulators, and policymakers have intensified as governments attempt to design legislation capable of supporting innovation while also protecting investors and maintaining financial stability. These discussions involve some of the most powerful institutions in finance and government, all trying to determine how digital assets should coexist with the traditional banking system. If those frameworks succeed in creating a stable regulatory environment, the next phase of blockchain adoption may unfold much faster than many people expect. And when that happens, the infrastructure built by companies like Ripple could become a central component of the evolving global financial architecture. One of the most fascinating developments unfolding in the digital asset industry right now is the increasing level of interaction between blockchain companies and political leadership in the United States. For years, the cryptocurrency sector largely operated on the edges of traditional finance, often facing skepticism from regulators and policymakers who were uncertain about how decentralized technology should fit into existing financial laws. That dynamic, however, has begun to change. Conversations are now taking place at levels of government that would have seemed unlikely only a few years ago. According to individuals familiar with discussions inside the Ripple ecosystem, Company executives and other crypto leaders have participated in policy roundtables aimed at shaping the future regulatory framework for digital assets. Some of those conversations have reportedly included high-profile political figures such as Donald Trump, illustrating just how seriously governments are beginning to evaluate the role blockchain technology could play in the global financial system. The purpose of these meetings is not to favor a single company or promote one cryptocurrency over another. Instead, the objective is to develop a clear set of rules that allows blockchain innovation to grow while still operating within a transparent and legally defined environment. Policymakers understand that if the United States wants to remain competitive in financial technology, it cannot ignore the rapid evolution taking place across digital payment networks, tokenized assets, and decentralized financial infrastructure. Ripple executives have consistently framed their company's mission in a way that aligns closely with these regulatory discussions. Rather than positioning themselves as a speculative cryptocurrency venture, Ripple presents itself as an infrastructure provider designed specifically for banks, payment processors, and institutional financial players. Through platforms such as Ripple Payments, institutional custody services, and the underlying network known as the XRP ledger, the company aims to modernize how value moves between countries and financial institutions. At the center of that system sits XRP, which functions as a bridge asset capable of connecting different fiat currencies during cross-border transactions. When a payment travels between two countries with separate banking systems and currencies, XRP can act as an intermediary layer that converts one currency into another almost instantly. Instead of waiting several days for correspondent banks to settle a transaction through traditional clearing networks, blockchain-based settlement can finalize the transfer within seconds while processing thousands of transactions every second. This capability becomes particularly important in international payment corridors where liquidity is scattered across multiple currencies and financial intermediaries. By providing a neutral bridge asset that moves quickly and efficiently, Ripple's system attempts to remove many of the delays and costs that currently exist in cross-border banking. The broader political conversation surrounding digital assets reflects a dramatic shift from the skepticism that once dominated regulatory thinking. Early in the cryptocurrency era, many policymakers viewed blockchain primarily as a speculative technology associated with volatile trading markets. Over time, however, financial regulators and central banks began recognizing that the underlying technology has the potential to transform financial infrastructure itself. Even experienced figures within the regulatory community have acknowledged this transition. For example, former Christopher Giancarlo has repeatedly argued that the traditional banking system still operates on decades-old settlement architecture that was never designed for the speed and scale of modern global commerce. According to Giancarlo and others who study financial infrastructure, blockchain-based settlement layers could eventually replace portions of those legacy systems by enabling instantaneous transfers of value between institutions. Yet despite recognizing this technological shift, banks cannot simply rebuild their payment networks overnight. Financial institutions operate under strict compliance requirements and must ensure that any new infrastructure they adopt fits within established legal frameworks. Building blockchain-based settlement systems requires massive investment in technology, security, and integration with existing financial platforms. Banks are unlikely to commit those resources unless they are confident that regulators support the transition. That reality explains why many traditional financial institutions have recently joined cryptocurrency companies in calling for clearer digital asset legislation. In earlier years, banks often remained cautious about publicly supporting crypto-related policies because the regulatory environment was uncertain. Now the situation has changed. Large financial firms increasingly recognize that blockchain infrastructure could reduce settlement costs, accelerate international payments, and unlock entirely new financial markets built around tokenized assets. In order to participate in that transformation, however, they need legal clarity that defines how digital assets should be issued, traded, and integrated into existing financial systems. As a result, policymakers are hearing pressure from both sides of the financial industry. Technology innovators want rules that allow them to build new platforms without fear of sudden regulatory crackdowns, while banks want assurance that their investments in blockchain infrastructure will remain compliant over the long term. The convergence of these interests is gradually pushing governments toward comprehensive digital asset legislation that could reshape how financial technology evolves over the coming decade. Looking back over the history of Ripple reveals that much of what is happening today was discussed years before it became reality. In an older interview with company leadership, Ripple executives explained that their mission was never simply to create another cryptocurrency project competing for market share. Instead, the company set out with a much more ambitious objective: transforming the way value moves around the world in the same way the internet transformed the way information moves. That vision centered on solving the enormous inefficiencies of cross-border remittances, a market measured in the hundreds of trillions of dollars when you include institutional transfers and corporate settlement flows. At the time, Ripple leadership insisted that if they succeeded in modernizing this system, the impact would reshape global finance. If they failed, the company would simply disappear. Over the years that followed, Ripple continued refining its infrastructure while gradually expanding into adjacent areas such as tokenization, custody, and liquidity management. Many of those sectors now sit at the center of the blockchain revolution unfolding today. The next phase may involve the integration of artificial intelligence with blockchain settlement networks, enabling automated systems to execute billions of microtransactions across digital economies. Ripple has already begun positioning itself for that possibility through partnerships with large financial networks, including MasterCard. If those technologies converge the way many analysts expect, the number of automated transactions flowing through blockchain networks could eventually reach into the trillions. That future may still be years away, but the groundwork is already being laid through infrastructure, partnerships, and regulatory engagement happening quietly today.